Did the market just flip? Well, we gotta go back to Thursday to see what's going on right now because there was a huge day that week. So we have a tweet here from Andreas Steno Larson, and he says the CPI report came in Thursday with headline at 7.7% and core at 6.3%, both lower than expected. And boy, oh boy, did risk assets like that. Everything was partying like there was no tomorrow. To show you what he's talking about, let's go to that ETF that epitomizes risk. We're gonna go to the ARK ETF, ARKK. This is Kathy Wood's fund, and we could see over the day from, let's say, opening on Thursday morning until close, ARK was up like almost 14.5%. I mean, that is obviously a giant one-day rally for an ETF, or any ETF, or any stock. That's a huge day. And it actually didn't stop there. It actually kept rallying. So the next day, Friday, you could see a rally all the way into, I don't know, let's say when it probably hit some resistance around, we're gonna go Tuesday of this week. So just a couple days ago, a little resistance, and now it's down a bit. But it went up another 8% from that almost 14.5% rally. So we're talking about risk on here. Now on Thursday, it wasn't just the riskiest of the risk that were rallying. So here we have the S&P 500. Check out this gap on the close from Wednesday up into the open. So up 3.5% in that from the close on Wednesday up to the open. So that gap, we got a big gap here. And if we take a look at the open on Thursday and we go up to where we were talking about maybe some resistance it was hitting, let's talk about up another 3.4% through about Tuesday as well until it maybe hit some resistance. So we're really talking about a giant, I'd say a giant rally in the stock market over the past, let's say, week. So just from a little bit better than expected inflation expectations, we had a giant rally, honestly, a huge rally. Huge rally in the S&P 500, huge rally in risk assets. It was crazy, okay? So this is kind of a situation that the Fed's put themselves in. Any little bit of information that's going to make it look like the Fed may not be raising interest rates as fast or as hard as people are thinking is going to send the market way higher. And for example, if they stop raising, if they came out and said the economy is really breaking right now, we're going to take our foot off the gas, the stock market's going to absolutely, it's going to moon. It's just going to rip, right? And so this is what we're dealing with. There's no way to know when that happens and if it even happens, but if it does happen and you're not invested right now, you're not going to take part in this whole thing. Now, that doesn't mean to say that this is a good time to be investing. It's just that you never know. And that's the whole part about just trying to time the market. How are you going to know if this does happen? So, but let's say things aren't exactly looking great in general in terms of, let's say, the economy. Here we have Michael Canto. He works for Cantor Fitzgerald. I think he's the chief financial, or he's a chief investment officer or something like that. So he says here, a new bull market doesn't begin until the data stops going down. The NAHB is the start of the hope cycle. We're gonna talk about it in a second. A great leading indicator of employment with a lag and has collapsed in 2022 at a record pace. And over here you can see, this is the NAHB, the National Association of Home Builders Index, where they go out and they survey a bunch of home builders to try to figure out what's going on within the industry, and it's a leading indicator of the economy. And look how just drastic the decline has been in the NAHB, okay? So let's go and take a look at this hope index that he's talking about. And I've covered this before on the channel. Basically, this is a framework that I really like to put things into context, and I think it's great for people watching to probably help you understand maybe the economy a bit more. So there are leading indicators, which are on the left side here, which is housing, okay? Housing is a leading indicator. So you're gonna see maybe the ripples of potential issues after interest rates go up in housing, okay? And this was showing a roadmap for how the economy responds to changes in rates, okay? So the first thing you see is you see it in housing. So it starts slowing. You see it here in the NAHB, okay? It starts there. And as that goes down, it just goes through other places. You have new orders, you have profits, and you have employment. Okay, where are we right now? Let's talk about some of these things, okay? So here's the Empire State Manufacturing Survey, and we go here, say new orders, right? Here we have manufacturing on this one, okay? So how's this looking? Absolutely freaking awful. Absolutely awful. Liz Ann Saunders, the chief investment officer, I believe at Charles Schwab, I believe it's chief investment officer is her title. Outlook for new orders from Empire Manufacturing, PMI, has fallen to lowest, most negative in the history of the survey. Absolutely terrible. Very bad, okay? Not a good look for that hope index that we're talking about. look how low this is. It's lower than 2008. It's hitting where 2008 was. This is very bad. Here we have Jurian Timmer. He is actually from Fidelity. Not to spoil the fun of last week's rally, but the earnings picture continues to weaken, with 75% of companies in the S&P 500 seeing estimate downgrades. Based on the shape of the yield curve, this could get worse before it gets better. This is a very interesting chart. So the other thing, if we go back to Hope, we have profits here. And now profits, let's say in terms of earnings, we want to understand what's going on in terms of earnings in the stock market, because this can be a potential indicator, right? And it's supposed to flow into earnings, right? So we go to housing, new orders, and we get to earnings. So take a look at the earnings. Okay, S&P 500 is this black. So of course it's down quite a bit. We're at 4,001 when this was last done. Let's focus here on this pink area. And so you can see pink is the percent of S&P 500 companies with higher next 12 months earnings per share versus the 3 months ago, 3 months prior. This is it's a mouthful, but it's easy to understand, okay? If you go back 3 months, so 3 months ago from right now is that September? No, sorry, August, okay? You go back to August. What was the 12-month forecasted earnings, okay? That was a number. You take that number. Now, what's the number now? The next 12-month forecasted earnings right now. Did it go up or did it go down? And so what's happening is it's definitely going down. We're at negative 25%, okay? So what this is saying is earnings estimates over the next year are definitely going down. We also have the yield curve here. So this little blue line is the yield curve, okay? And what's the yield curve? Well, this one is actually taking the 2-year versus the 10-year, right? So if you, a 2-year treasury, 10-year treasury, right? So I'm just gonna give you a number. I don't know what the number is, but let's say 4% were the bond yields right now on 2 years. Well, if 2 years were 4, usually the 10-year would be a little bit higher, like 5, okay? And so the spread would be like 1%. But what's happening now, there's an inversion. So the shorter term yield, the 2-year, is actually higher than the 10-year. And so it's getting a little crazy, and that's a weird thing that usually happens in terms of recessionary periods. And so we're way below here. So we were at, we were not at an inversion, and now we are, right? So we're down here, and it's pretty low. So, okay, we have an inverted yield curve, right? So that's another recessionary type thing. Simon Rhee over here says if stocks are to make new highs after sell-off, historically, these 4 factors need to be present. So yield curve is not inverted. Well, we just talked about that. It's inverted right now. Earnings are growing. Well, we just talked about it. Earnings are not growing. Economy is still expanding. Actually, the economy is actually still expanding, okay? We'll talk about that in a sec. Credit spreads are not widening, so apparently they're not. Historically, unless all 4 of these areas are green, then it's not going to happen. We're not going to hit all-time highs. That part about the economy still growing, well, we could see here, evolution of Atlanta Fed GDP now real. This is the real GDP estimate from the Atlanta Fed, okay? What is it? It's up here. So we have the GDP estimate is just over 4%. And so essentially what's going on is we have GDP growth that still looks pretty good, pretty robust, okay? What's that mean? Well, it could be good and bad. It could actually mean that, well, the Fed's gonna start raising rates keep raising rates just as much because it's not slowing down the economic growth, or maybe it's okay. Maybe things are just, GDP's still going up, but what the Fed's doing is still gonna work, and we're gonna get a soft landing, okay? This is where what we don't know is gonna happen. The other part here, let's go back to the Hope Index. So we have employment in the Hope Index, and this is the part where people start getting hurt, right? You start losing your job and unemployment starts to rise. And of course, that's probably the worst part of this whole thing is at the end of it, you start getting people losing their jobs. Now, the thing is, so far, we are not seeing unemployment really rising. So when we're looking at the numbers here, this is the unemployment rate from Fred. We're seeing a unemployment rate of 3.7%. So this is a very low unemployment rate. You can see it's almost as low as it is anywhere on this chart going back to 1990. So we're at a very low point for unemployment. So that's good, but it also means that it's possible that we're not quite there yet, meaning that we have a way to go until we hit maybe a true recession. Now here we can see the rent delinquency surge, and this is a tweet from Lynn Alden who says, "It seems to me like the small business rent delinquency trend isn't getting enough airtime." And so basically maybe these are some cracks that are starting to show up inside the economy. We have rent delinquency This is from December 2021, okay? Basically just a few months ago, not even a year ago, up until October of 2022. And so we could see that delinquency rates, okay, this is a high delinquency on the right, a lower delinquency on the left. Well, in New Jersey, I don't know, let's say 20-ish% was delinquency. It's almost at 50% now, okay? That's a giant jump in delinquencies. Massachusetts, big jump. New York, big jump. California, big jump. Pennsylvania, big jump. So we're seeing big jumps in things like delinquencies. Maybe next would be credit's going to start increasing, right? And maybe banks are going to start needing to tighten credit. And so there are potential cracks going on right now. What does that mean? Does it mean that there is a recession that's going to be coming soon? Maybe, probably, honestly. But at the end of the day, we don't know if it's going to be a soft landing, if there is a recession, or if it's going to be a hard landing. How bad do these things get? Do the interest rates that the Federal Reserve is raising, do they hurt so much? Are they doing it so fast that they break something and it ends up being a really big problem, essentially, and we get what's called a hard landing instead of a softer landing? That's what we don't know. So some of that was doom and gloom, I know, but we're going to end this as usual on a positive note on this channel. So we don't know when the market's going to suddenly pop and maybe you lose out on your returns because you're not invested, okay? That's why I'm still invested, and I usually always stay invested, okay? And you're buying at lower prices, and that's good, right? Because you want to buy at lower prices because when prices go up, it's much better for you, right? And even if you had buy at higher prices, you can average down and keep buying over time as the market goes down, okay? That's how I invest. That's how most long-term investors should be doing this. Bull and bear markets only last for an average of 20 months. So if you take all the different bear markets that there have been, going back till 1929, well, we have 20 months as the average. And we are about 11 months into this bull market, into this bear market, meaning that maybe there's only 9 months left if you take the average, right? Of course, it could be longer than the average. It could be shorter than the average. But what this means, you know, maybe by next year, 2023, we're back at all-time highs at some point. Basically, all I'm saying is if you keep investing through this bear market, you don't know if it's going to be a time where suddenly the Fed takes its foot off the pedal. Suddenly, we have higher stock prices. And you need to also remember at the end of the day that the stock market, it's predictive, okay? It's not going to say, well, once the economy is completely fine and we know that it's fine, it's going to go up. The stock market tries to predict that the economy is going to be going up. So it should lead the economy going up. And that's what you're not going to be able to figure out if you're thinking that we're in a recession, but the stock market is thinking the recession is going to be over in a few months, okay? You don't know. You have to be invested and have that same kind of way of looking at things to get through this. And so that's all I have for this video. I hope you like it. If you did, hit the like button, subscribe, disclaimer here, and see you in the next one.